Well, last week we told you about Warren Buffett's bet on the medical supply business, his purchase of more than 1 million shares in Becton Dickinson. Well, my next guest made the same bet before Buffett and held over 1.3 million shares at the end of the second quarter. Jim Tierney is portfolio manager at WP Stewart. And Jim, thanks so much for being with us here in the studio. Obviously, you think Buffett has made the right call. You made that call much earlier. Tell us exactly as to why this company could be poised for further demand in this business.
Sure, Betty. Thanks for having me. First of all, when we look at the healthcare industry, it's pretty clear to us that there's going to be reform in the sector. And to us, what we want to do is we want to play the guys that are going to get more volume, more lives are going to be covered. There will be a cost, and taxpayers are going to pay some of that cost, but the industry is going to pay some of that cost as well. So we're looking for companies that will get the best volume benefit and have the least cost of achieving those additional volumes. So when we look at somebody like a Becton Dickinson, we see them in a very good position. They have basic medical supplies and testing equipment. They do everything from syringes to high-tech cell analysis systems. So we think they're very well positioned.
And these are cheap items, essentially, relatively speaking. So when you're talking about increase in volume, you're talking about an automatic increase in the supplies for these then.
Absolutely. And there are two parts to the store that are very intriguing to us. The first is that Becton Dickinson, we think, actually takes cost out of the system. They provide systems such as syringes that go back into the casing such that you prevent sharp injuries. So it's providing an overall cost reduction to the system, so that's very important. And secondly, we think Becton Dickinson is the low-cost provider in the industry, so very well positioned relative to their competitors.
Now, Buffett, of course, is always famous for coming into stocks after they've been beaten up. He sees the long-term prospects for Becton, but the stock got beaten up recently because of their earnings call. I mean, they said essentially that they see below-trend growth in 2010, and there's some sort of a loss in terms of their currency hedging gains. So in the short term, you really want to be in this stock, or? We
do, and I think that the third quarter earnings at Becton Dickinson were a little bit misunderstood. There is a hedging gain that they had from currency hedging all year this year that theoretically doesn't repeat next year, but currency is in a better position than it is for 2010 fiscal year than it is for fiscal 09. So I think there'll be some benefit that people aren't counting. And secondly, when they gave their guidance for 2010, they talked about if trends continue as they are. So they just took the first 9 months' results and extrapolated off of that. We think results come in much better than the first 9 months. And if you look at the quarters, they earned around 4% gains in the first 2 quarters, but 13% in the third quarter. So if you really want to go off the most recent trend numbers, it's double-digit gains. So I think the street just extrapolated off of a 9-month number, not really looking out to 2010, and the benefits that the healthcare plan is going to bring.
Okay, well, aside from healthcare, Jim, because I was looking over some of your holdings, you have some pretty big holdings in consumer companies, MasterCard, Visa, Target. You're betting on you're betting on a recovery?
Well, we at WP Stewart really look to the long term, and we're long-term investors. And I think that when you look out a few years, those companies are going to do very well as the consumer comes back, slowly, but does come back.
Okay. And I also want to mention, though, that you own P&G, and we just had that news out this morning about Warner Chilcott buying the drugs business, essentially, of P&G. This is basically part of the whole sweeping, I suppose you could say, or clean sweeping at P&G. I mean, does this represent the end of it in terms of this sale?
I think we're probably pretty close to the end. Procter & Gamble has always pruned the garden, as they call it, and this is another transaction in that process. They talked about this at their analyst day in late 2008, and so this is not a big surprise to anybody. I think when you look at the financials, it hurts them from a dilution perspective by about 15 cents or so, but it should improve the long-term growth rate. So the little bit that you lose from the lost earnings should be more than made up by a faster growth rate.
Okay, Jim, great to have you with us. Thanks so much for joining me on these various stock picks, including the one from Warren Buffett. Jim Tierney, portfolio manager at WP Stewart.